Lo que les proponemos hoy es un fireside chat con Jason, Mendelson, y los invitamos a que participen, a que puedan hacer todas las preguntas que quieran.
Like just plain vanilla terms, the only thing I'm negotiating now are valuation, option pool size, and what the board looks like. Those are the only three.
The idea is to demystify what raising a round is and what venture capital is. We're going to talk a little bit about.
We need to build more than just a superficial relationship. Our job, 95% of our human interactions are people asking us for things.
We all know that the best way to approach a VC firm is through a referral, but there are a lot of people out there that can't get those referrals, that can't figure their way in.
Your frustration of business plans, I also concur. And I think that if you're going to cold reach out to somebody you don't have a relationship with, it is critical that you're transparent. And I mean, impress me. You got one chance, right? This is not coming from a referral from somebody I trust. You're not getting the extra benefit of the doubt. Wow me. Show me how thoughtful you are. Show me how much you've thought of the metrics. Show me that you know your key indicators. Show me that you know the competition. Show me the success you've had. Because you get one chance.
I've seen VCs do things that if I were an entrepreneur, of course, with what I know now.
For me to say I know as much about any of the companies I'm on the board of or any of the companies I invest in, if I know more than the CEO, then I invested in a bad company. I should fire the CEO or I'm an arrogant jerk. And so let's assume that you go into a meeting first time with the VC, and if they're a know-it-all, that is a horrible, horrible danger red flag for me.
Which other characteristics should have the best and most successful startups in your portfolio?
You need to celebrate your wins. Like the teams that have persevered and grinded and have been resilient, but know when to take a step back and celebrate their wins, but not take it too much and get back to work. It's sort of like a sports team, right? You grind, you play the match, you win the match, you celebrate, but you get back to work the next day.
A good lesson for entrepreneurs here is that all parts of the economy have cycles, and VC is no different, because right here in Spain, we're still in that price inflation period, and I think a lot of entrepreneurs think this is just a straight arrow up, but things can change and things can change quickly.
The things I learned from that I never knew is that interest rates actually really affect VC. If you look at South America, they were on fire with venture capital, and then the interest rates spiked, and all the investors said, you know what, I'm just going to invest in debt. I'm not going to invest in startups anymore.
Is there something from the investor's perspective that could be done to fund those other companies that might have a slower growth rate, but maybe tend to profitability?
By definition, you can really only fund companies that you think will be the next Facebook. Right? You have so much money under management that you have to have these massive companies that scale quickly and that have these exits. There's certainly a bias now in the investor world, the limited partner world, the people who invest in us, that smaller funds are better. Maybe you've heard of Zynga or MakerBot. Those were big exits, or Adno. Those were big exits. Great. I'll take them all day long. But what you haven't heard is the 10, 12, 13 other companies of ours that sold for $60 million, and we had 10 in it, and we tripled our money, and because the fund size is small enough, that still returned more than 10% of the fund, and we've built a very well-performing fund structure on exactly what you're talking about.
I mean, one of the things that I have seen traditionally in the case of Spain is that companies that have grown very rapidly, at the end, the CEO, the founder, has got 5%, 6%. 7% of the company. Now, how is it possible that in the US, a founder, after going to the NASDAQ with 300 million behind, he still got 30% of the company?
That competition between venture capitalists drove down prices for entrepreneurs. Transparency in the process drove down information gaps between the entrepreneurs and the VCs. The entrepreneurs knew when they were getting a good deal or not. Those two things over the past 10, 11 years have radically changed the ownership percentages. Sometimes can be started with, first-time entrepreneurs, less sophisticated people who haven't built 8 companies. It's nice to have somebody local. I mean, in a perfect world, You want somebody who's local, that you love, that is going to have that daily relationship or weekly relationship that you can call, that you meet and have coffee or a beer, and then you'll have somebody who's from somewhere else who can give you a very different perspective.
What do we think about accelerators programs?
Love accelerators. Yeah, there's some bad ones, whatever, there's bad of everything. But reputable accelerators have become the absolute startup venture engine in many geographies which previously didn't have venture activity. If you look at internationally how venture activity has increased, every location I look at that is on a trajectory like this has some accelerators in town that are at a minimum, they're giving experience and training to the entrepreneurs, and at a maximum are really accelerating their companies to where they can get meaningful funding and meaningful networks and relationships.
Accelerators are great because they're there to help you prove out the metrics that will let us see that glimmer of something that allows us to take the next leap of faith and bet some money.
In terms of terms, where do you spend more time and where is more difficult to understand to the founders? Okay. And which is very well explained in your book, by the way.
Yeah, so here's the irony. The guy who wrote the book about term sheets and how to be smarter than your lawyer and venture capitalist, I don't send out term sheets anymore. We just posted our term sheet on our website and said, here are the terms. We'll give every company the same terms. Simple, preferred, like just plain vanilla terms. The only thing I'm negotiating now are valuation, option pool size, and what the board looks like. Those are the only three terms I negotiate anymore. And, what I've found is over 20 years, the vanilla terms don't matter to me. Like if the company's a massive hit, everybody wins. And if the company goes to zero or isn't, which is more than 50% of the time, why waste time on terms? And all those middle cases are usually getting renegotiated at the time of exit anyway. So, it kind of became, what are we doing? So, I realize the irony of this, but those are really the only things I'm paying attention to.
Thank you very much for your time.
Thank you.